Hello everyone, welcome to ACCA Taxation video lectures brought to you by AccountancyTube.com. We are still at capital gains tax. Now we are going to look at the shares aspect. So when we dispose of some shares, when you hold some shares in a company as an individual, so if I hold some shares in, say for example, Facebook, and if I dispose them shares, what would happen in that case? Just bear me 1 second while I share the question with you through the screen share option. My throat has been itchy so far today, and it will create some problem in this video lecture as well, I think. Excuse me. Right then. So as you can see on your video screen, disposal of shares for individuals. First of all, it says a share pool. Now the problem does not arise when we are taking the sales. So we'll take the sales at which we are selling the share. So we'll take the sales of that per share price multiplied by the number of shares. That will be our sales. The problem arises when we are calculating the cost of that sales, because I might be buying some shares in January, then I buy some shares in March, then I buy in June. So I hope that you would appreciate the fact that the share price in January would be different than the March. Again, the share price in June would be different than the one in March. So, excuse me, I will be buying shares at different timings in the year. So the share prices will be different as well during the time. So what I would be doing, I would make a number of shares. I would make one column of number of shares and then the amount of shares as well. So I'll be adding all of these shares in the share pool. It is called share pool, where I will be adding number of shares and total cost. Now after some time, companies does issue bonus shares as well. Now say for example the company gives the bonus shares, I hope that you know that bonus shares does not involve any cost, they are given for free. So if the company says that I will give you 2 shares for every 3 shares you already hold, then in that case we will add the number of shares, but in the cost we will add it 0. Likewise for rights issue as well, we will add number of shares, but the cost will be less than market value, so we will take that cost in that case. So it will keep increasing, and whenever we are selling the shares, then we will take the average cost of that shares and we will deduct that from the cost. Now that is under normal circumstances, but there are certain the different rules as well. We will look at them in details. Now if you look at your lecture notes, share pool consists of all the shares purchased before the date of disposal. 2 tracks of maintain number of shares and the cost. When shares are sold, then the cost of the shares in the share pool is apportioned according to the number of shares sold in the pool. Now for individual, there is a matching the matching rule for the sale of shares. Now when I've sold some shares, I had 1,000 shares in my pool. Now I'm selling 100 shares out of that pool. Now we will see in the pool that when we have purchased them shares. So first we will sell the shares which we have purchased on the same day. So it says first one, shares purchased on the same day will go first in the sales. Then after that, shares purchased on the following 30 days, and then finally shares from the share pool. So that is a criteria to sell it. After that it says rights share and the bonus shares. I've already explained to you. Then comes the the takeover and reorganization. Now sometimes one company is took over by another company. If say for example Facebook has bought Snapchat, then if Facebook has bought Snapchat and Facebook said that Facebook said to the shareholders of Snapchat or Instagram that whatever shares you hold in that company, I will issue you new shares. Just give back to me them old shares. I'll give you new shares and I'll give you some cash as well for every share you hold. So in that case we'll have to calculate the cost of the new company's shares. Right? So how do we calculate it? We normally, if the cash is involved as well as the shares of the new company, so we'll take the cost of the old shares multiplied by the cash which is given under the new scheme divided by the cash plus the new shares. So that's how we calculate it under the takeover and reorganization structure. Excuse me. If there are quoted shares gifted If the quoted or the listed shares are gifted, then that's how we calculate the capital gains tax purposes. When quoted shares are gifted, the value, the market value for CGT purposes will be calculated as follows, which will be lower of. So we'll take the lower quoted price. Lower quoted price will be given to us in the question, plus the difference of higher quoted price and the plus half of the difference between the higher quoted price and the lower quoted price. And the next one is the highest market bargain, and next one is the average of the highest and the lowest market bargain. So we will take that, and whichever is lower of these two, we will take that one. Right? Now on the next page, if you come, it is a chargeable gain for companies. How do we calculate chargeable gain under the companies? It will be exactly like individuals. However, companies do not get annual exempt amount. What do they get is they will get indexation allowance. Now indexation allowance factor will be given to us in the question, so we'll simply multiply that factor to the cost or enhancement expenditure, so that will be deducted out of the cost as well. Now as you can see on your screen, so we'll take sales, then incidental cost of sales, net proceeds, then we'll deduct the cost and enhancement expenditure, which will give us the unindexed gain. Then we'll deduct the indexation allowance on the cost. So we'll take cost multiplied by indexation factor, and then indexation factor multiplied by enhancement expenditure as well. Then finally it will give us the indexed gain. Then we'll deduct the current year capital loss out of that, and then the loss brought forward as well. And the final figure is going to be chargeable gain, because there will be no annual exempt amount for the companies. Now, what is indexation allowance? Companies get indexation allowance from the date of purchase to the date of sale of an asset. So from every sale, whenever there is a sale of shares, then on every date of sale, we will be taking the indexation allowance from the previous sale to the new sale. All right, so we'll be taking the indexation allowance from the previous date of sales to the new date of sales. Whatever purchases we have done, we will be taking the indexation allowance on that. Indexation allowance cannot change the gain into the loss. So if there is a gain, we can reduce that gain to zero with the help of indexation allowance. We cannot create the loss. Thus, if there is a gain, then indexation allowance can maximum reduce the gain into zero. Indexation allowance cannot increase the loss. If there is already a loss, indexation allowance will not be able to increase the loss. And the loss, then there will be no indexation allowance. And how to calculate it? We'll take the index cost and we'll deduct the cost out of that. So that will give us indexation allowance. However, in the exam, you will have to apply the second rule, which is indexation factor multiplied by the cost. Now sometimes indexation factor will not be given to you in the question. You'll have to calculate it. Excuse me. So how do we calculate it? Index factor, as I said, index factor will not be given to us. So we'll take retail price index, which will be given to us in the question, in the latest date less RPI in the earliest less RPI in the earliest date, divided by RPI in the earliest date. So retail price index in the latest date less retail price index in the earliest date divided by RPI in the earliest date. Right? And after that it says a disposal of shares in the companies. So in individual cases we'll make a pool differently. However, for companies we'll make Finance Act 1985 pool. So in that pool we'll be putting all the shares in that pool, so they won't be the same day thingy. So three tracks are maintained: number of shares, cost, and index cost. So index cost will include indexation factor as well. Index cost is updated by index rise, adding indexation allowance at each operating event or each subsequent purchase and sales event. And then it says that when shares are sold, then the cost and index cost of the shares in the share pool are apportioned according to the number of shares sold in the pool. Right? Now if you could excuse me, if you could open up your BPP exam kit of F6. I was using F6 notes, however this lecture is exactly same for F6 and P6. because you will find the same study material in your P6 notes as well. If you come to your BPP exam kit, question number 127 please, of current version BPP exam kit please. Question number 127, as you can see on your video screen as well. Now it says Louis has two chargeable gains from disposal of shares in the tax year 17-18. So two chargeable gains, £8,000 claim made for entrepreneur relief, so entrepreneur relief claim is made on that, and 13,100 a claim not made for entrepreneur relief. On 13,100 claim for entrepreneur relief is not made. Louis has a taxable income of £34,000 in the tax year 17-18. What is Louis's capital gains tax liability for the tax year 17-18? What is the capital gains tax liability for the Louis's? Now the asset qualifying for entrepreneur relief, we know that it will be 10%. So 8,000 at the rate of 10%. Assets qualifying for entrepreneur relief. Now her income is £34,000, which means that she is a higher rate taxpayer, so the remaining amount will be at the rate of 20%. So 13,100 will deduct the annual exempt amount out of that, and on remaining amount it will be at the rate of 20%. Right? And the next question, question number excuse me, question number 20, question number 128, I think it is, which we have to do next. Question number 128. Neil bought 1,000 shares in GPLC for £1,500 in October 2004. First read the requirement. In the requirement it says, what is the cost of the shares sold in February 2018? Now some shares are sold in February 2018, so he wants to know the cost of them shares which were sold in February 2018. Now first of all, Neil bought 1,000 shares in GPLC for £1,500. So 1,000 shares was bought for £1,500. So just keep writing these shares so that we will have an idea. So 1,000 shares, cost was £1,500. After that, in November 2006, there was 1-for-2 bonus issue when the shares had market value of 240 each. Now market value was 240 each, but these were bonus issues, so we won't write down the value of that. However, we will write down the number of shares. So it is 1 for every 2 you already hold. So it will be 1,500 divided by 2. So it's going to be 750. 1,000 shares. So it's going to be 500 more shares. So for every 2 you already hold, will give you 1 share. So 500 more shares without any cost. In July 2011, there was 3-for-1 rights issue. So for every 1 share that you already hold, we will give you 3 more shares at a reduced price of £270 each. At that time, the market value was £3. However, it was given for £2.70. So they already hold 1,500 shares, aren't they? So they hold 1,500 shares. So for every 1 they hold, they will get 3 more shares. So it will be 4,500 shares. So 1,500 times 3 is 4,500 shares, and the cost is £2.70 each. Right? So 4,500 times £2.70. So whatever this figure is, that will go into this this place. And after that, it says Neil took up his full entitlement to shares under the rights issue. Then it says Neil sold all of his shares in GPLC in February 2018. What is the cost of the shares sold in February 2018? So when she sold all of these shares, so whatever this total cost is, that will be her cost. So which is the answer of this question. Right? Excuse me. Now we have to do another question as well, please. If you come to question number 209, please. Question number 209. Question number 209 of BPP exam kit, please. Let me open it from the exam kit as well. Now, as you can see on your video screen, first of all, we'll do question number 208. Then we'll do question 209 as well. Now this is a huge question. We'll have to read the scenario, and there will be following questions which we'll have to answer. So first of all, we'll read question number 208, please. No need to read the scenario for this, just read the question number 208. Identify by clicking on the relevant box. So it is for F6 purposes, so that's why it is asking for clicking, so it will be on computer. So identify by clicking on the relevant boxes. By clicking on the relevant boxes, where it is, whether each of the following statements concerning the indexation allowance is true or false. So it is about indexation allowance. What do we know about indexation allowance? Indexation allowance can reduce a gain to nil but not create a loss. Is it true or false? Yes, it is true. And the second statement says indexation allowance can increase an unindexed loss. Can it increase a loss? No, it can't increase a loss. So the second statement is false. Right? Let's read the I'm sorry. Let's read the question number 209 as well, please, now. And the question number 209 says, what is the Lunar Limited's chargeable gain on sale of PPLC shares on 29th of November 2017? So she, the Lunar Limited sold some shares on 29th of November. We'll have to read the scenario for that. Now, if you read the scenario, please, in the scenario it says, just give me 1 second. In the scenario it says that on 29th of November 2017, Lunar Limited sold its entire shareholding of £1 in a PPLC for 53,300. Now it is a share sales, but it is by company. So whenever a company is selling, there will be indexation allowance as well. So 53,400 is the sales. Then the cost of these shares, which were purchased for 36,800. So that is the cost. That will be our gain. However, we have to deduct the indexation allowance out of that. And for indexation allowance, retail price index is given. So how do we calculate it? RPI, latest RPI. So it will be latest RPI in this case is 273.8 less the earliest RPI, which is on 14th of June 2018. 14th of June 2008. So 273.8 less 216.8 divided by our latest RPI. So that will give us the indexation factor, which we will multiply by the cost of 36,800. Right? I hope that you got it. How do we do it? First, we'll take the sales, 53,400. That is our sales of the shares. Then we deduct the cost out of that, 36,800. That is our cost. After deducting the cost, we have to deduct the indexation allowance. So in order to deduct the indexation allowance, we need the indexation factor. How do we get the indexation factor? So the retail price index is given, as we have studied in our notes. When the retail price index is given, so we'll take latest RPI. Latest means by date. So latest date is November 2017. 273.8 less the earliest one on which we have purchased the shares. We purchased the shares on 14th of June 2008. So RPI on that date was 216.8 divided by our latest RPI, which is 273.8. I think divided by latest, isn't it? I think so. Let me check on the notes as well. Sorry, divided by, not latest, divided by earliest date of RPI. So we'll divide that by earliest date. Alright, so that's how we calculate the RPI. That's how we calculate the indexation factor. Then we'll deduct the indexation factor out of that, and the remaining amount is our chargeable gain, which was required in the question. That is our question number 209. My throat is so bad, I just want you to do the question number excuse me. I just want you to do the question number 211, please. If you come to question number 211, What is the unindexed cost of the Lunas Limited? Not even 211, 212 please. What is the cost of the just read this question please. What is the cost that was used to compute Lunas Limited chargeable gain on the takeover of Asteroid PLC on 12th of February 2018? So it is a takeover. I told you when it is a takeover, then we'll have to see that which company is taking over which. So in this case, that it says that Lunas Limited's chargeable gain on takeover of Astro PLC on 12th of February 2018. So for that as well, we'll have to read the scenario. Now if you come to the scenario, note number 4 please. In the note number 4 it says that on 12th of February 2018, Luna's shareholding in Astral PLC was taken over by CPLC. L Limited had originally purchased 10,000 shares in APLC and their indexed cost was £33,000. So that is basically cost. And what is asking in the question, it is asking us to calculate the cost for the new shares. So we'll take the cost of the old shares which is £33,000 multiplied by cash, if any, received, divided by cash plus the new shares. So under the terms of the takeover, for each of its £1 ordinary shares in APLC, Luna Limited received £6.50 in cash plus £1 ordinary shares in CPLC. So £6.50 is the cash for every share. So she holds 10,000 shares, so 10,000 times £6.50. And then it says that plus £1 share in CPLC as well. So divide that by 650 times 10,000 plus 450 times 10,000. So we'll take the cost, which is £33,000 cost, multiplied by cash, which is received, 650 times 10,000, that is the cash received, and divide that by cash plus the shares, which are the new shares. So the price of the new shares is 450 per share. So that's how we'll calculate the cost. Right, then please redo this question and do the remaining parts of this question as well. I will see you in the next video lecture, and we'll continue with our journey of capital gains tax probably tomorrow because my throat is very bad today. I'll see you in the next video then. Goodbye.